All right, so today we're doing something really cool. We're going to pull back the curtain on how pro crypto traders actually manage their money. We're talking about a strategy they use to generate income while, and this is the key part, keeping a really close eye on risk. We'll be breaking down the entire process step by step using a real live trading account as our guide. This is the real deal. So, you ever wonder how the pros really do it? I mean, it's not just about buying and holding, right? They're actively building these complex portfolios that can make money in different market conditions, all while keeping risk on a super tight leash. That's the big question we're digging into. It's all about being active, being dynamic. Okay, here's the plan. First, we'll build the core position. Then we'll see how automation does the heavy lifting to keep things balanced. After that, we'll talk about scaling up with margin, getting better prices with some advanced tricks, and what to do as the portfolio gets bigger. And of course, we'll check out the final score at the end. Let's get started. All right, section 1. So first things first, right? You gotta have a position to manage. The main idea here is to make some income by selling options. And the way our trader does this is by creating what's called a short strangle. Sounds complicated, but it's not. It just means you sell a call option and a put option. It's basically a bet that the price is going to chill out and stay inside a specific range. So in our case study, the trader already had a short put on their books. To make it a full strangle, they just needed to add the other side. So they sell a call option, the 40,000 strike, with the same expiration. Now they've got both sides. And this creates that bet we were talking about, that Bitcoin's price will stay somewhere between their put and their new 40K call. If it does, boom, they pocket the premium from selling both of those options. Okay, but here's the thing. The moment you add that new option, you've knocked your portfolio out of balance. It's not neutral anymore, and that's a problem. But this is where the cool part comes in. The automation that basically works like magic to fix it. See, that new short call you just sold, it has its own lean, a directional bias. In the options world, we call this delta. It's just a number that tells you how much the options price will change when Bitcoin moves $1. So by adding this new position, you've just pushed your whole portfolio off kilter. It's suddenly exposed to price moves. And if your goal is to be neutral, well, you can't just sit there and do nothing. And here's the fix, happening in real time. Check this out. An automated tool immediately spots that imbalance. So before the hedge, the portfolio was a tiny bit short Bitcoin, using these things called perpetual futures. But literally seconds after that new call option was sold, the tool jumps in and buys $830 worth of those futures. It completely flips the position from short to long, and just like that, balance is restored. So what did we just witness? That, my friends, is delta neutral hedging. And that seesaw you're looking at, it's the perfect way to picture it. Think of your options portfolio as the weight on one side. The automated hedger is what adds just the right amount of counterweight, those Bitcoin perpetuals, to get the whole thing perfectly level again. The whole point is to try and make money from something other than just guessing which way the price is going to go. Okay, so we've got our core position set up, and we've got the automated hedge running. Now it's time to think about growing, right? Putting more capital to work. But you can't just go wild and start adding trades. You have to be smart about it. And that means managing your margin. This chart shows you that balancing act perfectly. Margin is just borrowed capital that lets you make bigger trades. So right now, the trader's using about 20%, pretty low. But their goal is to get that up to around 45%. Why? Well, that's kind of the sweet spot. It's where your capital is really working for you, generating returns, but you're still leaving a huge safety buffer from that 100% level. That red bar, that's the danger zone. That's liquidation, the line you absolutely, positively do not want to cross. And here we see that idea put into practice. The trader looks at their account and sees margin usage is actually under 10%. I mean, that's just not efficient. The capital is just sitting there, not doing much. So that's the signal, the green light. Time to add another short strangle, this one for a December expiry. This puts more capital to work and boosts the portfolio's income-generating power. All right, so the portfolio is bigger now, but just adding size isn't the whole game. The next level of thinking is, are we getting the best possible price on these trades? This is where we get into some more advanced stuff, optimizing how we enter these positions. This table makes the trade-off super clear. The trader could have just taken the instant price available, the best bid, quick and easy, but instead they used a special order type, an implied volatility or IV order. Think of IV as the market's fear gauge. So this order basically says, hey, I'm only selling if the fear gauge is high enough to get me a better price. Sure, it took 3 hours for the order to fill, but look at the difference. That patience earned them a bigger premium. It's a classic case of speed versus a better price. Now, we've got multiple strangles running, different expiration dates. The portfolio's getting bigger and way more complex. This means the original strategy has to change. It has to evolve. What works when you're small just doesn't cut it when you scale up. And here's the new problem. You can see it in the quote. A bigger portfolio means bigger gamma. Now, if delta is the speed of your portfolio, think of gamma as its acceleration. It means your risk profile changes way faster now with every little price tick. If you keep the same settings, your automated hedger will be freaking out, trading nonstop to keep up, and all those fees will just eat you alive. So what's the solution? You adapt. And this timeline shows you exactly how the trader did it. They slowly widened the rehedging thresholds. The highway lane analogy is perfect here. As the portfolio got bigger, like a bigger truck, they literally widened the lanes. They gave it more room to drift around before the automated system would step in and nudge it back to the center. This is so important. It cuts down on all those tiny, expensive trades and makes managing a big position way more efficient. Okay, this is a real pro tip. This is gold. Remember, a short strangle has 2 parts, selling a put and selling a call. The put has a positive delta, the call has a negative delta. So when you put them both on, they kind of cancel each other out. The problem is, if you add one at a time, your hedging tool might react to the first leg before you even place the second. So here's the smart way to do it in 3 steps. First, you temporarily widen those thresholds way out to basically pause the hedger. Second, you execute both trades, the put and the call, all at once. Third, you tighten the thresholds back to your new normal level. What you get is one single, clean hedge instead of 2 messy and totally unnecessary ones. Super efficient. So, after all that, adding positions, tweaking the hedges, being patient with our orders, the big question is, how did it all turn out? What was the final score? And maybe even more important, what are the big lessons here? And here it is, a 2% gain on the portfolio. And get this, that was in just 3 weeks of active trading. It just goes to show you when the market conditions are right, this kind of strategy can really deliver a solid return. So let's wrap this up. What are the big takeaways? Number 1, balance is not static. It's a living, breathing thing you have to constantly manage. It's not set it and forget it. 2, margin is your friend. It's the fuel for returns, but you have to respect it. You have to watch it like a hawk. 3, patience pays, literally. Using those smarter order types can get you better prices. And finally, number 4, and this is maybe the most crucial one, you have to adapt. As your portfolio grows, your tools and your strategy have to grow with it. You know, this whole thing, it shows a strategy that worked beautifully in a pretty stable, calm market. But that leaves us with one massive question, right? Think of this strategy like farming on the side of a dormant volcano. The soil is incredibly fertile, it's profitable, but what happens when that volcano decides to erupt? What happens when volatility just explodes? And that, right there, is the risk you are ultimately getting paid to take.